All right, let's get into it. Today, we're diving into a real head scratcher from this past earnings season, and it's all about a company called Crescent Capital, ticker CCAP. We're going to unpack the market's really strange positive reaction to their Q2 numbers. So let's figure this puzzle out. So picture this. The story starts out simple enough, and frankly, not looking too good. A company comes out with its quarterly report, and, well, by all the usual metrics, it missed the mark. But then, the weird part happens. The market opens and the stock doesn't sink. It doesn't even stay flat. No, it jumps, closing the day up over 3%, and on some pretty heavy volume too. And that, right there, is the kind of thing that tells you there is a much deeper story going on. I mean, just look at the contrast here. On the left, you've got the misses. Their net investment income, or NII, came in 2 cents lower than Wall Street was hoping for, and total revenue missed by almost 1.6 million bucks. But then you look to the right and you see a completely different reality from investors. The stock pops 3.3%, with trading volume almost double what it was the day before. What gives? This really brings us to the core question we're tackling today. What on earth did investors see that wasn't in the headlines? Why would the market reward a company that, on paper, looked like it didn't deliver? Let's start digging. Okay, first things first, a quick backgrounder. Crescent Capital is what's known as a BDC, a business development company. All you really need to know is that these are special companies that invest in small and medium-sized private businesses. It's crucial to get this, because they're judged a little differently than, say, a big tech company. And that brings us to NII, or net investment income. Remember, this is the number CCAP missed. For a BDC, NII is everything. It's the key measure of how much money they're actually making from their investments. It's basically their version of earnings per share, and it's what they use to pay out those all-important dividends. So yeah, a miss here would normally be a very, very bad sign. So if that big headline number was a miss, then smart investors were clearly looking past it. They were rewarding other signals about the company's actual health and its long-term strategy. So let's peel back the layers and see what they saw. And boom, here is our first major clue. Even though they missed the analyst estimate, the company's core earnings, that NII we just talked about, still covered their regular dividend by 110%. So for all the investors who own this stock for the income, this was the real headline. The dividend wasn't just safe, it was more than covered. Rock solid. Oh, but they weren't done there. Not even close. Management went all in on returning cash to shareholders. First, they kept their regular dividend going for the 38th quarter in a row. Then they confirmed a final special dividend was on its way. And then they dropped the real bombshell, a brand new $20 million share buyback program. And you don't have to guess why they did it. Just listen to the CEO, Jason Bro. He said it loud and clear. He basically said, "We think our stock is cheap right now, trading for less than our assets are actually worth. So we're stepping in and buying our own shares." I mean, that is a massive vote of confidence from the people who know the company better than anyone. Okay, so powerful shareholder returns. That's one massive piece of the puzzle. The second piece, you find that when you look under the hood at the quality of the loans and investments CCAP actually holds. And when you look at their portfolio, you see it's built like a fortress. A whopping 91% of their investments are in what's called first lien loans. All that means is that if a company they loan money to gets into trouble, they are first in line to get paid back. It's the safest place to be. This screams that their strategy is all about avoiding risk. And their risk management is just as impressive. Look at this. Management is super transparent. They tell you that about 14% of their portfolio is on an internal watch list, which just means they're keeping a close eye on it. But the percentage of loans that are actually in trouble, the ones that have stopped paying interest, it's only 2.4%. That huge gap between the two numbers shows you they are way ahead of the curve, flagging potential issues long before they become actual problems. So we've got strong capital returns and a super defensive portfolio. The last piece of this puzzle is context, right? How does this one quarter really stack up against the company's performance over the long haul? And this chart says it all. This is the hero graphic. Since CCAP went public, they've been through a pandemic, they've been through crazy fast interest rate hikes, and through all that, their net asset value per share has actually gone up a little bit. Meanwhile, over that exact same period, the average BDC saw its value fall by more than 10%. This record this stability in chaotic times, that's what earns trust with investors. So now we can put all the pieces together. The market's positive reaction, it wasn't a glitch. It wasn't a mistake. It was the market delivering a verdict on what really matters for a company like this, especially in today's economy. So let's wrap this up and see what to watch for next. So here's the story investors actually bought into. They just ignore the tiny earnings miss and focused on these 4 crucial things. Number 1, the dividend is totally safe with 110% coverage. 2, management is super shareholder friendly with more dividends and a new buyback. 3, the portfolio is a fortress built on the safest kind of loans. And 4, they are a proven performer with a history of protecting value when others couldn't. So, looking ahead, here's what you want to keep your eye on. How much of that $20 million buyback do they actually use? Can they get that small number of non-paying loans down even further? Are they making new investments faster than old ones are getting paid back? And of course, the big one, can they keep that dividend coverage strong? These are going to be the clues for the future. And all of this leaves us with one last really interesting question to think about. For years now, Crescent Capital's whole game has been about playing defense and playing it better than just about anyone else. But now, with management's confidence shining through with a buyback, you have to wonder, is this defensive powerhouse finally ready to start playing a little offense?